I use, monetary tightening as in the rate of change of monetary tightening, plus commodity prices, plus inflation, all of this stuff, and the dollar. I think it's the largest tightening of monetary conditions in all economic history, as far as I can find, and it just happened really fast. So, yeah, as you said, this is not a crypto event. This is just.
Welcome to the Daily Crypto. With the jobs report, rising bond yields, and talk of a looming recession, there is no doubt that the present state of the economy is placing an extra burden on the shoulders of the people, while at this time of making this video, Bitcoin is still just below the $20,000 support. What is going on with the economy? What would the market recovery look like? How would all this affect the crypto market? Keep watching to find out as we answer these questions with the co-founder and CEO of Real Vision, Raoul Pal. We are currently experiencing an economic downturn. What is going on with the economy? Raoul Pal says we are headed for a shock recession. Watch.
It really is a follow-on for the last piece I did on Real Vision on the platform and explained to people my macro view, which was that we were very likely to be going into recession. It was likely to upset markets for a period of time. And there were certain markers I was looking for that would usher into the next phase. So I'm going to walk you through in a bit more detail now where we are now. So the first chart that I want to show is the Financial Conditions Index, which is basically a combination of commodity prices, the rate of change of rates, and the rate of change of the dollar. That against the ISM, which is the Purchasing Managers Survey, which is a good guide to the business cycle, is a 9-month lead. It's one of the best indicators we've got. And what it shows is financial conditions tightened by the fastest rate in history. And that is leading us to expect that the economy is going to have a Wile E. Coyote moment where the ISM goes from 53 down to, let's say, 35. 35 is a severe, sharp recession. Now, that indicator is already bouncing as bond yields are starting to come off, and I'll come on to this a bit in a minute, and oil's come off a little bit. And it kind of suggests we're going to see a sharp recession when it comes to the things that they monitor, because then unemployment becomes more important, because unemployment means voters and other stuff, even recession.
Still on the economy, Pal adds.
So the next chart to bring up is the ISM new orders less inventories. That's a 3-month lead, and that suggests the ISM in the next 3 months is going to 45, which is a full recession. So it's saying we'll be in a full recession within 3 months. Okay, that's starting to get interesting for us. Now, the issue here is inventories. So the next chart is the chart of wholesale inventories of durable goods. I mean, that chart is shocking. And there's different types of inventories, and most of them show something similar. Is that inventories have gone up because everybody stocked because of the supply issue. They overstocked and now demand has gone. Demand has gone because the financial conditions have tightened, and inflation has taken away discretionary spending. So now everybody's got too much stock. Now, building of inventories is positive for GDP in the equation for GDP, and releasing inventories is negative. Normally, to get rid of inventories, you lower prices too. So that starts to get interesting to say, if they're going to have to clear all this inventory, they're probably going to have to lower prices. So that's the next big debate, inflation.
Like crypto? How does this affect the crypto market? Raoul Pal explains.
Against the year-on-year rate of change of Bitcoin, you can see it's a dominant driving factor of the overall direction. It is not the only factor, but a dominant driving factor. Now, global money supply has been shrinking because everybody's been tightening. So that has reduced the price of Bitcoin. So that was the crypto winter was essentially in that chart. The following chart shows that the money supply is cyclical too, and the ISM leads it by 9 months. And the ISM inverted suggests that the M2 rate of change is going to start rising again. So that basically tells us things like Bitcoin and risk assets, which ties into the NASDAQ being cheap and the exponential aid stocks being relatively cheap, there is a potential big turning point in markets to come. What I'm waiting for is that turn in bond yields. I think yields are forming a head and shoulders top with 265 in the 10 years, 275 in the 10 years as the neckline. If it breaks that, then we're going back below 2%. Inflation break-evens are already falling, so we've seen them fall sharply, and I'm expecting the oil market to show more liquidation. Monetary tightening, as in the rate of change of monetary tightening, plus commodity prices, plus inflation, all of this stuff, and the dollar. I think it's the largest tightening of monetary conditions in all economic history, as far as I can find. And it just happened really fast. So, yeah, as you said, this is not a crypto event. This is just a liquidity event.
How bad could this be?
The thing that will pause the longer-term picture is a demand destruction. And Warren talks about it as well. I think we are going to see more demand destruction in a shorter, sharper period of time.
Raoul Pal states that the inflation we will get out of this recession will be much less than people are expecting, but in the meantime, we have to brace ourselves for the heavy economic impact. Where are we exactly in this cycle of pain? Raoul gives his expert opinion on this. Watch.
The pain of tightening is already in the market. So the probability is that the other side of a recession where conditions loosen is the thing that eventually gets priced in. So as Sam kind of suggests, is that the markets have now, crypto markets, and I showed that with that M2 chart, have priced in this full thing. So it's already there. Again, the Fed are a kind of noise because it's the actual bond market that does the tightening, not the Fed. So the Fed, wherever they are in rates, is irrelevant because the bond market, pushed it all the way up to 3.6% or whatever it did in 10-year rates, and same at the front end. So I think it's a lot of the bad news, however much that is, whether it's 80%, 90% or 100%, is in the price.
Raoul asks, how many bad positions have been washed out now, especially in the current market condition in which we have seen this kind of long-term capital management style blow up? The kind where everybody was lending to the same counterpart, and when the counterpart goes under, everybody goes under. Raoul points to the similarity between the long-term capital management and the Three Arrows capital blowup, and how Celsius is somehow linked to it and everything else. So he concludes, normally these things are towards the end. Now that we know this, what would the recovery process of the market look like? Would it be that the current position of the digital asset market is going to make this rebound look different? Or would you expect to see prices resume their climb in the way they have traditionally? Raoul confesses that he does not know if we have seen the low, but he has been averaging quite aggressively in recent times, making his biggest addition to his crypto bet since 2020.
I don't know where the low is. Could a drop in economic conditions cause further short selling or panic? Possibly. I think the low is close. Whether it's in or not, I can't tell. But I know from all of my economic work, and I've probably got maybe 200 charts to back up all of the stuff I showed, that suggest the balance of probabilities are that a lot of this has been priced, that we've got the inflation problem is probably a thing of the past.
Pal indicates that economic growth is going to fall sharply. What happens after that?
We now have this Pavlovian instinct of the market looking forwards and saying the Fed are going to pause and monetary conditions are going to ease. Now, don't forget that financial conditions index that I showed you, the global macro investor one. Well, that prices in commodity prices and the dollar and yields. So if yields start coming lower, commodities start coming lower, and the dollar eventually tops out, which it's not clear that that's going to happen yet, but at some point it will, then you've got all of those reversing.
We hear a lot of analysts talking about the next phase of the markets is when earnings goes down. Well, Raoul points out that these charts kind of suggest that it has already started happening in the price. And yes, he adds maybe there is a final leg lower, as they have to price in even the lower ISM that he thinks is to come over the next 9 months. The co-founder of Real Vision makes an interesting observation. He points out that the markets tend to bottom before the ICM does. To fully understand his point, Raoul takes us back to 1947, where the market actually bottomed in line. Fast forward to 1974, it bottomed 3 months beforehand, and more recently in 2018, it bottomed 9 months beforehand. Raoul adds that there is still some more downside to come, but there are other trades that really interest him. Crypto, perhaps? He has been averaging big. Why not? Is there a chance Pal is wrong on this? He responds.
The 1974 short, sharp contraction of the economy and contraction of markets is not that it's 2001-2 or 2008 all over again. In which case, you get a false rally that goes on for a period of time, and then it rolls over and has another whole set of lows. Those are the 50% sell-off style scenarios. I don't see that in the forward-looking data because I think it looks sharper and shorter than people expect, but that is a possibility. So it's really hard to call in these things, trying to pick lows and stuff is not easy because, many people got carried out in 2002. I remember it really well. Then 9/11 hit and then the whole thing rolled over again and it destroyed people. So, these kind of markets are not easy to trade. The bond market tends to be the easier trade, but it's been hard because of the inflation story has been so sticky. But when it gets easier, that's an easier place to make money.
Thanks for watching this video. What do you think about Raoul Pal's aggressive averaging? What are your DCA positions? Drop your comments in the comment section below. Don't forget to smash the like button, share our video with your friends and family, plus subscribe to our YouTube channel for more amazing content. See you on the next one. Bye for now.